Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account. Today my account has earned $1,094. Today US stocks fell mixed for a third straight week. In my account, SQQQ rose for 2.23% to 36.29, and DRV rose for 1.3% to 43.02. Today's market showed a mixed close, with oil and gas decreased for more 2.64%. And the other oil and gas ETF, BK2058, decreased for 4.14%. On the other hand, auto manufacturers and drug manufacturers all rose by more than 1.4%. Today, Dow Jones Industrial average rose for 0.39%, Nasdaq decreased for 0.58%, and S&P 500 decreased for 0.28%. Dow Jones closed slightly higher but recorded 3 consecutive weekly losses. Yields on 2- and 10-year Treasurys climbed to new 3-month highs. Given that the Fed is most likely to stick to aggressive monetary policy to curb inflation, investors are concerned that the economy and the stock market may be adversely affected by the monetary policy in the future. On Friday, yields on both 10-year and 2-year Treasury notes climbed to their highest level since November, weighing on the index. A series of economic data released this week on CPI, retail sales, and PPI all showed that U.S. inflation remains high, reinforcing market expectations that the Fed will continue to raise interest rates and maintain high interest rates for longer. Of inflation indication tracking wholesale prices, the U.S. Producer Price Index rose 0.4% month-on-month in January, higher than economists had expected. After Thursday's PPI data, the Fed swaps market was fully priced in anticipation of a 25 basis point rate hike in March and May each. Some analysts expect the Fed to raise interest rates by 50 basis points at its next FOMC meeting in March. Oanda market analyst Craig Erlam said, "While spending a lot of time, it seems like in the end of the PPI data has shaken investors' optimism that U.S. stocks will keep rising. The latest data tells the market that achieving a soft landing is still a very difficult test, and the next journey will be bumpy." In its latest report, Bank of America strategist Michael Hornet expects the S&P 500 to fall to 3,800 on March 8th. He expects a hard landing for the economy in the second half of the year, which will weigh on the U.S. stock market. St. Louis Fed President James Brad's hawkish speech on Thursday adds to the pressure on U.S. stocks. Mr. Bullard says he supported a 50 basis point rate hike at the Fed's last policy meeting, and he did not rule out a 50 basis point rate hike at the March meeting. On the same day, Cleveland Fed President Mester said she at the FOMC meeting in early February that there was a convincing reason for a 50 basis point hike, and that the Fed needed to raise rates above 5% and keep them for a while, after which how much more would depend on the data. She also believes that the upward risks to inflation remain, and that the January CPI data released this week suggests that the Fed has more to do with containing inflation. Goldman Sachs economist, led by Jane Jesus, said in a note, "Given strong growth and more stubborn inflation, we expect the Fed to raise rates by another 25 basis points in June at a peak of 5.25 to 5.5%. UBS believes that if core inflation is above 3% before its June meeting, the Fed will raise rates even longer, with rates peaking at 5.4%. Investors have raised their expectations for the extent of the Fed's tightening cycle. In July, they now expect the federal funds rates to climb up to 5.2%, depending on the trading in U.S. money markets. By comparison, just 2 weeks ago, investors expect a peak interest rate of 4.9% versus the Fed's current target range of 4.5% to 4.75%. Beyond comments from Fed officials, consumer status has been a key focus for investors this week, especially given the latest round of inflation and retail sales data. Liz Young, head of investment strategists at SoFi, said, "I think the stock market is listening to the current situation of consumers. Retail spending rebounded, consumer confidence rebounded, the services PMI rebounded and pulled off the contraction zone. One thing to be happy with, the labor market is still tight." He added, "But I don't think we're pricing in consumer spending or worrying enough about it. Savings drying up, wage growth is falling, and it cannot support future spending levels. Debt is piling up." Thank you for listening. Don't forget to subscribe and like. See you next episode.